Jim O'Neill, chairman of Goldman Sachs Asset Management, joins us live on the phone line from London. Jim, such a pleasure to have you live on the show. What's your sense now that the Greece debt deal seems to be largely in place? The euro area finance ministers are said to be approving this as well. Do you think the worst is behind us in Europe?
Well, first of all, I frequently believe people exaggerate the importance of some of these European issues. As troublesome as they have been, and some aspects may remain, Europe is not the world. I'm very fond of saying that China creates the equivalent of another Greek economy every 11 and a half weeks. And the four BRIC economies between them will create the equivalent of another Italy this year. So people need to keep all these things in perspective. And I say all of that because as soon as you get some calming of the European tensions, it's easy for markets to do better, as we've seen for much of the past few, including last week. So, all that being said, there's plenty of other challenges around for Europe amongst the many different issues that do concern the French elections coming up in May. So, I think it would be inappropriate of me to suggest that the European pressures and challenges are going to disappear, but we need to get them into context.
Jim, hi, afternoon. Let's chat about India then. What do you think the Eurozone debt restructuring means for emerging markets like India, and whether or not will we see a continuation of the risk on trade?
I think India needs to do things to look after itself. I mean, India's obviously part of the BRIC club. It's an economy that's trying to become, let's call it adult, like some of the most developed economies in the world. With its demographics, India's got arguably the best potential for GDP growth of any economy with a size of $1 trillion. And what it needs to do is stop this constant stop-start problem dominated by the incohesiveness of coalition Indian politics. There's I don't know whether you guys have seen it, Boston Consulting Group have just issued a high report arguing the dollar value of Indian consumption in the next between now and 2020 is going to go from just under $1 trillion to 3.6. So a trebling of the role of consumption, saying India to be 6% of global consumption. That's the kind of work that I have done myself with my colleagues, and that's the kind of potential India's got. What you need is slight improvements in the way India is governed and led, and if that happens to occur, then the ongoing developments in Europe are almost, not completely, but almost relevant for India.
You were talking about your expectations from the budget and the key reforms that you think need to get done this time around.
Well, I don't know whether the budget will deliver on the things I'm thinking of, but need to have much clearer and simple clarity of macroeconomic policy, in particular as to the true role of an inflation target and what is it and how important is it. Secondly, the flip-flopping on FDI, particularly as it relates to retail investing, that's really bothered investors around the world the past few months, and it seems to be influenced by whatever the latest regional election has been, and India has to stop that. Thirdly, it has to continue down the path it has been trying, which is to sow the seeds for a much vaster expansion of education for those that are effectively marginalised out of Indian society, because India can only achieve the kind of potential that I touched on earlier if more and more people are educated enough to be fully participant in the labour force.
Jim, just to go back to the point that you were making about state elections here in India, there is a popular opinion that the government will go ahead and announce a very populist budget more than a more economically prudent one after the state election results, and hence the Indian macros may come under further stress. Do you agree with that view?
I don't have a strong view on it, but I'm going to be watching for that pretty closely. I mean, obviously, given the disappointment for the Congress Party from the recent election, there is a risk that could happen, but the markets are already somewhat concerned about India's fiscal position. If you look at it relative to, I often joke, if you look at the whole BRIC countries and what I call the growth markets, the BRIC countries together with Korea, Indonesia, Mexico and Turkey, the other 7 could all walk into European Monetary Union's criteria tomorrow, if they were daft enough to geographically shift to Europe, all those 7 would walk into EMU tomorrow, and only 2 of existing EMU can actually meet them. But India can't. So India stands out as being weak relative to the others on such criteria, and it needs to avoid constant populist vote-buying measures, not least because they don't appear to work with the voters either.
Let's also talk about the equity market here in India, Jim, because we've seen quite a phenomenal rally in the last couple of months, largely driven by liquidity. Do you see it continuing going into the year? Because, like you're saying, it's unlikely that too many reforms are going to get done in this year, and the fiscal condition is obviously pretty poor.
Well, with the Greek thing out of the way, as you touched on at the start, we've got some pretty benign circumstances globally. Virtually every major Western central bank has taken additional steps towards easing monetary policy recently, with the most recent one, of course, being the Bank of Japan. They meet again tomorrow, and they're probably going to give us further hints of what they might do in addition going forward. So you have got incredible liquidity being thrown at financial markets by the US, the Fed, the ECB, and the Bank of England, the 4 most important ones around the world, arguably. And now we have the Chinese easing as well. So all of these things are effectively inducing investors to seek out riskier returns or higher returns. And within the equity space, whilst India's valuation still doesn't look especially cheap compared to others, given India's long-term potential, obviously against that kind of background, people are very interested in looking at the Indian market. So I'd put it slightly differently. India doesn't need to do that much in terms of marginal improvements in order to attract a lot of global money that's looking for higher returns.
So, Jim, given the kind of strong flow of liquidity that Indian equities are currently seeing, would you have a Sensex year-end target in mind, or would you wait it out in terms of what the government actually does on policy reforms and then take a call?
I'm in a fortunate position where I don't have to think of targets and things like that these days. But, I started off the year thinking that this was going to be a very good year for global equity markets. Across the board, they were cheap, whether it was developed or developing. I believe the S&P could get to 1,500. We're kind of halfway there. And against that background, there's a very good chance that many of the growth markets could easily put in between 20 to 30%, if not more. And I don't see any reason for that changing, particularly after a highly encouraging non-farm payroll number in the United States on Friday.
Jim, before we let you go, quick final word on gold, your view on precious metals specifically, because many believe that gold will remain a safe bet as central banks continue to be cautious.
If you look at the policies I touched on before about Western central banks, relevant for gold, in essence, they're telling us that they're going to keep so-called real interest rates very low for a long time, and that, from my experience, is the main reason why gold is so strong and could strengthen further. So, in that sense, the monetary fundamentals are good for gold. The dilemma is, as we saw in the past fortnight, there's a lot of capital that's been attracted to gold but ultimately doesn't need to stay in it. And you don't need much of a surprise in order to cause a major correction very quickly. The great escalator-elevator theory seems to hold up in gold more than many other markets. So it's not a smooth ride. I can see us getting close to 2,000, if not more, but I think it will be very, very choppy still, and at some point the gold price will fall back dramatically when central bankers start to hint that they can exit some of these strategies. So it's only for the brave, in my opinion.